Welcome everyone to this edition of Lynk Speaker Session, where we'll be having a conversation about the latest trends in ESG. I'm Isabel Wong, Lynk Studio Lead and the host of this speaker series. Lynk Speaker Session is brought to you by Lynk Global, a technology platform that unlocks insights of the world's greatest minds. By using data to understand and organize experts and their expertise, Lynk has been intelligently connecting business leaders and decision makers with over 780,000 experts across regions and industries. Now, back to the theme of today's conversation, because investments based on ESG practices are gradually gathering traction because of the strategy's relatively strong performance during the global pandemic. While ESG is not a new trend, pressure from investors and growing institutional appetite for sustainable options have accelerated due to the global push into sustainable investing, especially in 2020, where we have seen governments channeling virus-related recovery funds into health and environmental projects. While ESG strategies are still accounting for around 1.4% of assets under management in emerging markets, the global pandemic has raised questions about the role of asset owners and what could be done to drive more sustainable recovery. What kind of growth can we expect to see in the coming years for ESG? And also, how can companies and businesses approach ESG disclosures? But joining us today to answer all your questions is Kimberly Stafford, Head of Asia Pacific and Managing Director of Pimco, where she's also the Global Investment Firm's Executive Committee. With over 2 decades of experience in the investment management industry, Kimberly has worn all sorts of hats at Pimco, including Global Head of Consultant Relations, Global Head of Human Resources and Talent Management, just to name a couple. Not only is Kimberly the 2019 recipient of the 100 Women in Finance APAC Industry Leadership Award, she's also recently featured as one of the female leaders of our newly launched Buy-Side Power Women series. Now, a little bit of introduction about Buy-Side Power Women series, because it's actually Lynk's latest interview series that features conversations with female leaders and male allies on the buy side to increase visibility of women in the investment management industry. The series covers topics including how advocacy for diversity could influence future capital allocation. And if you're interested in reading a lot more recent interviews that we've done for Buy-Side Power Women, please feel free to go ahead and scroll through at the link shown in the current slides right now. It's campaign.link.global/Buy-Side-Power-Women. Or you could basically keep updated and check out our latest content with on social media with the hashtag Buy-Side-Power-Women. Now, before we actually jump into the conversation of the day, to make this session truly interactive, we would like to start with a question for all of you. So now we will just bring up a poll to learn more about your interest in terms of ESG investing and what are some of the ESG themes that you've been watching closely. So the first question that we're going to ask everyone in the of our audience member would be, which ESG theme is currently on your radar? You have the options of A, climate change, B, diversity and inclusion, C, healthcare, D, digitalization, and E, green recovery. We could just spend the next 10 to 15 seconds to just go ahead and vote and let us know what you're interested in knowing about. We will share the poll results later on in the session. And meanwhile, Kimberly and I are also taking notes here also just to see how we could cater our conversation later on around the topics that you are most interested in. But before we jump into the conversation, a little bit of instruction in terms of any questions that you would like to submit for Kimberly in the Q&A section that she could answer later on. You could just feel free to go ahead and use the Q&A function on Zoom, or if you're joining from your mobile, you can simply send your questions to us at insights@linkknowledge.com. We'll go through some of your questions in the Q&A section later. But now, without further ado, let's go ahead and bring in our speaker of the day, Kimberly Stafford, Head of Asia Pacific and Managing Director of Pimco. Kimberly, so good to have you on this dreary day in Hong Kong, but we're talking about something very exciting. So because as you're an experienced leader in investment management. Could you share with us your thoughts and overview of how the ESG landscape is quickly changing due to what's going on this year?
Absolutely, and thank you so much, Isabel, for having me today. I'm delighted to be joining on this really important and exciting topic around ESG and investment management. And I also really want to applaud the Lynk Global team for their incredible efforts in bringing people together, not only on these topics, but on the buy-side women's initiatives as well, which is so critical for our industry to make sure that young women understand how wonderful the careers are and how dynamic they are. On the investment management side. So thank you very much for that. I think Isabel has framed the questions into kind of three main areas, but which we thought would cover a lot. And then as she mentions, would be thrilled to take your questions and direct the discussion into areas that you find most interesting. And we thought we would start with the first one, which is really kind of the biggest pushback that we get about ESG. And the question is just around, is this the right time to think about ESG, and can you really allocate money at a time when things are tight, and tight meaning, yields are very low, different plans need continued strong yields, returns. And so is there a trade-off for ESG, as there traditionally has been, where you've got to give up return in order to seek the benefits of a sustainable impact in terms of your investment? And this may have been the case in the past. So I think it's a relevant topic, but today more than ever, we think that you do not have to give up return for social impact, and actually integrating ESG into your investment processes and into your investment allocations will actually give you a better risk-adjusted return. So not only is it a question of, gosh, can I afford to do this, but I think importantly, really a question about, can I afford not to think about this? And we think about that from a couple of different factors. One, if you just look at the very, very high level, if you think about the economy and financial markets as a powerful engine for sustainable growth, it's clear that we cannot achieve sustainable growth over the longer term without sustainable investments, and that it cannot come at the expense of society. And so these things, I think, are being recognized. And as Isabel mentioned, certainly COVID is an accelerator, which we'll talk about in a moment, to some of these themes, and brought them into sharp focus during this period. So we think that you can think about ESG really as an important risk factor, particularly in fixed income, where we come from at Pimco, that companies and issuers who are not taking notice and integrating ESG factors into the way that they run their businesses are going to be less competitive, and frankly are going to expose themselves to risk, which means that the return that you derive from those companies who are not doing the right things will actually be lower than those companies who are taking a notice of that. And we see this already. There's a lot of winners and losers across the industry in terms of how people view these things. So one is on the issuer side, where we already see rating agencies looking carefully at ESG risks and how companies are monitoring these things and applying industry ratings on those issuers that directly impact their cost of capital. So this really hits their bottom line if they're not doing the right things, and they need to go to the market and it's costing them more. That's going to impact their business model negatively. The other aspect, which is really quite important, is the consumer demand element, where you and I are demanding that the products and the services that we want to be delivered are sustainable in some way, whether those be green products, whether they be electric cars, all of those things, which just means that those companies who are integrating those important aspects will achieve greater demand by the consumer, by you and me. So those are two main elements why we think that this is really an imperative, and less a question of, gosh, a budgeting issue, and do I really have the budget to allocate here. I'll just give one more example here in Asia Pacific. In Australia in particular, we see that marketplace and clients really being ahead of the curve with respect to ESG. They've long invested in this space, even before we've thought about it recently in the last couple of years. And the trends that we see there are actually clients who are looking at their existing asset allocation and just converting their existing mandates into ESG mandates. If they have a global bond mandate, they expect the manager to be integrating ESG into the process by which we're managing their global bond portfolio. And that is really where we think the ultimate destination is, where ESG, it's not a standalone strategy, it's not a different function, it's completely integrated into the way that companies and countries are evaluated. And as an investor, you get the benefit of ESG into your investment process. Now, we're a little ways away from that, particularly in certain markets and in Asia, but we're seeing those trends really accelerate at quite a great pace. So the second part was, well, what are those accelerants? And certainly COVID, we think, has been an accelerator to that process, mostly because there's been so many things that have come into sharper focus over this period, whether it be themes around social inequality, whether it be things around employee safety, healthcare, and reorienting that around the important COVID aspects. A lot of emphasis around supply chain vulnerability and making sure that the companies that you deal with can deliver in certainly in stressed periods. And then it also brings, anytime in this case, we have a global pandemic that really highlights absolutely how small the world is and how interconnected it is. It highlights other things that, connect us as a world. And this is where things like climate have an even bigger platform to stand upon, because I think people realize that that's such an important global trend that frankly we can't ignore. So all of those are just a few examples of areas where we see this accelerating. On the issuer side, we've seen about $20 billion in ESG related bonds. Those are mostly in the area of green bonds, as well as social bonds, or some have been calling them COVID bonds, that have come across to help fund some of the important areas of focus for companies during this period. And then we continue to see a lot of momentum on the client side, where we've seen over 95 billion in flows into ESG strategies in 2019 alone. And it's on a pretty high track in 2020 in terms of the market demand there. So definitely accelerating in terms of the market forces there. And then maybe just the final point, I mentioned it before, that sort of the holy grail is integrating ESG fluidly into investment processes, that it's not a standalone thing or a bolt-on aspect, that we include it in everything that we do. And the way that we think of it at Pimco is we have long since always looked at financial risk metrics to evaluate whether a company or a country will pay you back, and whether the bond that we're investing in is money good and will deliver the return that our clients expect of us. But now we look at ESG factors right alongside those non-financial factors. So every company that we look at, we'll look at the traditional financial factors, and then we'll have sections for E, S, and G, and how those themes are impacting the company, and are they doing the right things? How are they competitive? And how in totality can we assess the risk profile of a company? And we just think that that's a more robust and smart way to evaluate your investments and to help us realize a stronger return on investments. So that's kind of the punchline in terms of the how we start. How do we do it? Well, we take a top-down approach. We look at global macro themes that would be aligned to ESG factors and see how those are trending. Then we look at really careful bottom-up analysis, looking at every country and company along several risk factors to make sure that we've got a really good picture of how a company is performing along ESG lines. And our approach is really kind of 3 steps. One is exclusion. We call it the 3 E's: exclusion, evaluation, and engagement. Exclusion, we want to exclude companies who we don't think are being a little bit tone deaf on some of these factors, who are not incorporating them, who frankly are just not being innovative and frankly won't be competitive, where we think they'll actually have a lot of risks that will present themselves and not deliver the return that we expect. So we want to exclude those companies. We then want to evaluate the rest of the universe and look again carefully at both the financial and the ESG non-financial factors to evaluate the competitiveness of a company. And then we want to engage. We want to engage with company management to really understand, these are the CEOs and the CFOs and the chief operating officers, to understand how they're taking these ESG factors to heart and what things they are implementing in a company. Because we know that not every company is doing all the right things today. But what we really want to see is it part of their strategy? Are they improving? Are they on the right track? And are they a company that we think will provide a strong return because they're quite focused on these risk factors. So those are just a couple of aspects for the investment process, and kind of we've broken it down to 6 major tools that we tend to use. So one is we engage through bond issuance. So we go to an issuer and we say, gosh, you need money for a project or whatever it is. Let us help you structure it. Here are the things that we want to see. Here's how we want it to make sure that we can measure impact. So the bonds that we buy reflect some of these important risk factors. We want to, as I mentioned before, encourage positive impact with company management. So have that really fluid dialogue with the C-suite to make sure that they're taking these things to heart and allow us to track the progress around these key measures. We want to understand what the material ESG risks are for a company, and again, make sure that they've got a plan to address them. We also look at, we manage, for example, a lot of sovereign and emerging market portfolios. So we're engaging with countries. And so a lot of engagement with sovereigns to understand their policies around these important ESG factors and how they're implementing them on a countrywide basis. And then for things like climate, we want to see specific targets around climate so that we can track KPIs and make sure that we can see progress there. And then we want to collaborate. There's a lot of groups out there who are similarly aligned on this, whether it's financial accounting to make sure the disclosures are very consistent so that as an analyst you can look at any company and know what they're doing in this space. That's an evolving space, but one we think is quite important for the future to ensure that we can attract and track these important risk factors. So again, a lot of things to take consideration. It's a work in progress, but it's something that I think together as an industry we are making a lot of progress on, and hopefully we'll reach that end destination where we're not talking about ESG as a theme. It's just fully integrated in every single thing that we do. So let me pause there, Isabel, and maybe we can take it in any direction you'd like.
Thanks for the overview, Kim. Now, before we talk about the following questions, we would like to go back to the poll that we did earlier to check out that what are some of our audience members most interested in terms of ESG themes that they've been watching. Now, we can see the poll results that 43% of our audience members are interested in climate change, and it is a category that has so far got the most interest in the audience members within this session. And actually, it's interesting because most of our audience members today are based in Asia and Europe, and there's this interesting piece of information where there's this regularly conducted poll by the Center for Climate Change Communication dating back to November. It was already showing that half of Americans have expressed that they are at least somewhat concerned or worried about climate change. And that number has increased to 2/3 of the country in the last 2 polls taken last November and this April. So it's interesting to see somehow the interest and also the themes that people are watching around the world, they are largely similar. But now, before we go to the Q&A section, we would also like to ask our audience members another question. So now we'll bring up another poll. So after listening to Kim's comprehensive overview of the ESG landscape, I would like to ask our audience members the following question, which is, do you think ESG will take center stage in a post-COVID-19 world? You have the options of yes, ESG will dominate most investment strategies. B is no, ESG is only a trend, and C is wait and see. We could use the following 10 to 15 seconds to just go ahead and vote, and we'll come back to the results at the end of the session to see to understand what our audience members actually think today. But now we can continue with the conversation with our guest today, Kimberly. So thank you so much for your overview in terms of how Pimco, what are some of the options that Pimco have in terms of for the clients to approach ESG, and how you guys are somehow approaching measuring the performance of ESG funds. But then, of course, ESG is getting the attention like never before this year. It's only fair to say that more and more ESG focused funds will be established in the coming years. But while funds may be listed as ESG focused, depending on the markets that they are in, standards could be quite different based on the practices observed overseas. So what are some of the metrics to assess the performance and sustainability of a new fund? How do asset owners actually differentiate between substance and gimmick?
No, I think that's one of the key questions, Isabel, because this is a newer area of investing, the standards are not consistent. And so it can be really difficult from an asset owner perspective to discern and differentiate, those that are sort of truly ESG related funds, and those that maybe it's more of a marketing or gimmick. So I guess I would look at it around a couple of different lines. One is that we have seen a lot of regulators, even in the last couple of months, really put this as a high priority in their market. Certainly the SFC has here in Hong Kong, MAS has in Singapore. We know in London that that's the case as well, because there's a real need to bring some consistency. And a lot of it has come through the reporting, that there's certain risk factors that you have to disclose as part of your disclosure statements to allow people to be able to do some robust analysis on each fund. But honestly, that is a work in progress right now. Those have not been finalized quite yet, but we would expect over the next year or so that we would have much clearer guidelines in order to do that. We've also, partnered with different industry groups, as I mentioned. There's groups around financial accounting that, in terms of financial statements, is really helping to, be a thought leader on clarifying and making consistent portions of financial statements that would be dedicated to ESG risk factors to, again, just really provide some consistency between reports on an issuer basis. Now that then helps them feed in at the fund level, if as an investor investing the fund, to ensure that that's a critical part of the analysis that's done in terms of evaluating companies. I would also say, we also partner with groups like Climate Action 100 Plus, for example, which partners with companies and industries in high carbon emission industries to really help engage and advocate for KPIs around changes in climate that would have impacted their business, and having that flow through, again, to financial statements or to other reporting, so that we all have some consistent metrics around this. So it's a long-winded answer to say that I think it's coming together. There's a lot of different important pieces, but we do not yet have a consistent framework, which is going to be a continued challenge. But a lot of folks are quite focused here, and we would expect progress to occur, in the next 12 to 24 months in a big way.
Mm-hmm. Yeah, I see a lot of questions coming through from the audience from our audience members now. But one of the questions that I would first start off the conversation with, Kimberly, is that a lot of large companies, they often have more resources in terms of issuing ESG specific reports compared to smaller companies. So this is a question from a smaller company's perspective, because they usually have less resources. They might actually have less diversified or more domestically oriented investor base. So in order to get these small firms' ESG policies and standards up to speed, what would it take for them to get started?
Yeah, so I think that's a big challenge, and that's why if if both from a regulatory perspective and also from a financial accounting perspective, there can be a set of standards, then it's much easier, especially for smaller firms, to adopt those. They don't have to reinvent the wheel. They don't have to come up with their own framework, which can be tedious. They can just leverage, you know, what is out there. So I think that will have a trickle down effect to smaller organizations that may not have quite the infrastructure in those areas. But as a manager who's engaging with issuers of all different sizes, we would be asking the same questions of a small issuer as we would to a large company, and making sure that they're focused on some of the same things, and it's around ESG factors. So, you know, governance processes, diversity within the organization. I mentioned all the social elements that have particularly come up in the COVID period. And then of course, you know, environmental and climate considerations around those, and really looking at it as a partnership to help them, not throw stones, because that's not going to do anything, but help them think about a framework and various risk factors, and partner with them so that we can understand where they're making progress.
Mm-hmm. And the other question is that, of course, in the US or some of the Western countries and markets that we know, ESG is pretty much, their standards are pretty much established for quite some time now. But with the growing interest in ESG, we are seeing emerging markets and also China, they are trying to establish some sort of early stages ESG policies and commitments. So, of course, compared to the Western markets, competitors or other players, they are still in this very early stage. So what does it take to really create a market environment that is more conducive to higher ESG standards?
Yeah, no, I think it's a good point. And while I would give maybe the US credit, and I would definitely give Europe credit for being further along, I don't think anyone's sort of nailed it, right? And so this is an area that I think we can all continue to improve, and one where we've actually seen great global collaboration on global standards. Sometimes we see things that come up that are sort of unilateral amongst different regions or countries. And this seems to be an area where there does seem to be a lot of collaboration between countries and between regulatory environments to get to the right answer. So I'm quite encouraged. I think that means that we'll all kind of raise our standards and get to a better place more quickly. You know, I think if you look at a place like China, it does come from the top, and it's part of their strategic agenda in terms of a focus on climate in particular. And so that's an important starting point. And obviously from there, it's around, okay, well, what are the details and what are the action items and KPIs that they'll be holding themselves accountable for, and then to be transparent around progress on those items, especially for, you know, people like us who are going to buy Chinese bonds, maybe. You know, we want to see that transparency, and we want to know that they're taking it seriously and that they can demonstrate progress. And I think that that's a natural motivator for a lot of issuers if you have, you know, people like us on the other side kind of demanding that if we're going to be buying their bonds, which they need to finance their economies.
Mm-hmm. The other thing about that is hindering the growth of ESG is, of course, lack of education and awareness among clients and general investors, which would be at odds with an increasing level of interest from institutional investors to include these considerations in the investment process. So there's one audience member is basically asking, how do Pimco create awareness about ESG among its clients?
Mm-hmm. Well, I think you're right. I think that is the starting point, and it starts with education. And that's why we wanted to lead with the question about, you know, basically is ESG expensive, and can people even afford to pursue this? Because I think that's one of the biggest myths, is that, you know, maybe ESG is nice to have if you and you want to make a sustainable impact, but I can't afford to do it, either because I have a return requirement I'm trying to meet, or I have other liabilities that I need to fund, and I just can't afford to give up return in order to move forward on some of these other objectives. And I think we really are, you know, at a place increasingly where that trade-off is not necessary, and you can really get both. And I have to really, when we look around the world, in particular, there's European countries have been ahead of the curve in this respect because they have integrated ESG into their investment policy statements to say that this is, you know, a guideline or an aspect that we as a manager need to follow and demonstrate. And so by integrating it into the governance of how they wish their investments to be run, it makes us all sit up straight and ensure that we're focused in managing bonds and their portfolios in that capacity. So that's not a universal trend yet. We haven't seen that in other regions, but increasingly so on the institutional side. More and more institutions are integrating their mission and these requirements in their guidelines. And certainly when we fill out requests for proposals on a new mandate, we find that over 30% of the RFPs that we receive ask us explicitly about how we are integrating ESG into our portfolio management process. So, I mean, that's just a nice, circle because that forces us to, ensure that we can demonstrate that we're doing that. Other clients take notice, other clients ask, the investment management industry, and soon it becomes a bit of a norm and a imperative that as an investment manager, you have these capabilities, and that's quite self-fulfilling as we see and want to see more progress here.
To add to the education angle, there's this audience members asking whether or not including ESG as a subject in let's say students' curriculum would also be helpful in the longer run. Do you think so?
I think absolutely. I think one of the schools that has been ahead of the curve here for a long time has been Wharton. In their business school, they have a whole sustainability track, and they have for many, many years. That goes through all of their curriculum, and I do think that there's a generational element to this. We haven't talked about kind of specific pockets of demand for ESG, but certainly when we look at millennials, they care a lot about purpose just as much as they care about profit, and they tell us that they want that to be an area of focus for them as they're thinking about their investments. So that again is a great catalyst for us to continue to see demand. Women are another element where we often hear that they also care about purpose and social impact in addition to the return that they're achieving, and they want to know about their underlying investments and making sure that it's oriented in those areas. And the great thing is that women are managing more and more wealth as a percentage every year. They manage over half the wealth in the United States, and they manage about 30 to 40% in the rest of the world, and that's increasing by about 7% every year. So you have these strong cohorts of demand who say, okay, I have money to invest, and I want to make sure that there's a social impact element to it.
Yeah, and given the current market situation and some of the market forces this year that are not quite what we would say would not be normal, right? Some of the driving forces this year. Most ESG equity indices only exclude a limited number of companies that are fossil fuel related, which are underperforming due to economic downturn. So the performance is somewhat misleading in current conditions. Can this be sustained when we return to the so-called normal, and investors will investors still want to track those benchmarks?
I think so, but I think to the point, and it's a very good question, is that the universe of those companies and industries that we want to exclude continue to evolve, and this is where we want to understand what's important to our clients and focus in the areas that are important to them, and then also make sure that that we have an evolving picture. I mean, we could bluntly say, look, all fossil fuel companies are bad, right? Because they're negatively impacting climate change and these other important forces. Now, you could then say, well, I'm going to exclude that entire opportunity set from my portfolio because it's not an area that I want to support. Now, we might say, okay, if you look at that industry, it's highly concentrated. The barriers to entry for new energy suppliers is lower, and actually the places where you're getting innovation into renewables and other energy sources are from those, legacy entrenched energy providers who are being forced to change their business model. So we would say, don't strike it all out, but be very discerning and know which companies are actually investing heavily into renewables, into these other important areas of energy, and away from coal and other legacy areas that are inherently bad for the environment, and moving the right direction versus those companies who just frankly still have their head in the sand and aren't evolving and investing in the right direction. And that's where the active management element of being able to discern and differentiate and really do some bottom-up credit work to understand who's doing what and be able to talk to the management and understand that it's part of their strategy and see demonstrable progress. All of that's very, very critical in how we get to the right outcomes for these ESG strategies.
Another theme this year is also the recent theme is that in light of the death of George Floyd, and that essentially sparked the recent Black Lives Matter movement, that which have essentially put racial equality at the top of many investors' minds. Indeed, we've seen an acceleration of momentum around interest in these types of investments recently, but it's again back to the how question. Like, how can investors really invest in a way that can increase racial equality? How do we address the issues of diversity hires made by some companies, and let's say just rule out the entire idea of diversity hires? Is Pimco doing anything specific about that element?
Sure. Well, we're doing a lot in our own company, but then we also engage heavily that this is an important factor in, again, how we evaluate companies, both on the social side, because social inequality and diversity inclusion is quite important, and that manifests in many different ways, just in terms of the broader workforce, but also in areas like governance, where we would demand strongly that they have a diverse leadership team to make sure that there's good decisions being made on behalf of the company. So there's lots of different angles and ways that you can evaluate whether a company is doing the right things on this. I think what's the hardest part for an end investor, there is no fund that you can invest in, I think, credibly, that would say, well, gosh, if you put $1 into this fund, you are going to help some of these social inequality issues. It comes down to every bespoke company, their cultures, their practices, their policies. Are they doing the right thing? And that's what it's incumbent upon we as managers to make sure that we've got a pretty transparent picture about how they're addressing these important aspects. And if we see something wrong, that's going to be damaging to the company. And again, back to a risk factor. We think the best part is that on the best side of the scale, they're not going to be competitive because they're not doing the right things. But on the far side of the scale, they're going to be a risk because that company may no longer exist, or they may have a scandal, or they may suffer a lot of different aspects that will could permanently impede their standing position, which again we would not want to hold an investment in a company that was like that. So again, I think that the problem is it's hard to be more targeted to some of these important factors. But again, why you want to partner with a manager where you can see that this is a big part of the investment process and the analysis that would go into assessing each investment.
Mm-hmm. Since you mentioned the risk factor there, are there any measures that are actively being taken by investors in terms of protecting themselves from any ESG risks? Let's say when some some companies such as this audience member mentioned, Boohoo and Everlane, they were actually perceived as low risk companies, but still they were kind of hit by recent scandals. So what are some of the active measures that investors can take to protect themselves from risks like that?
I think that's really hard because those are examples where it wasn't evident, right? That there were these risks, and until these scandals surfaced, not a lot of people knew about them. And so, again, for better or for worse, I think it comes back to making sure that a manager that you're investing with is close to the management of the company, is close to the culture, can speak to some of these things. And there's always going to be things that are missed. There's always going to be scandals that surface that lie deep within a company that are really difficult to unearth. But the closer you can be to management and to these companies and just kind of seek out some of these issues and therefore avoid those investments, that's obviously going to realize the biggest return on your investment and frankly protect on the downside for some of these outliers as they occur.
Sure, and there's another question that came through. It's asking from maybe more of a startup perspective, because this audience member said they're exploring ESG and impact investors to fund their Series A and debt requirements. But what would be your advice in terms of at what stage does ESG funds usually enter a company, and how can startups really connect with institutional investors on their ESG commitment?
Yeah, so I actually don't think that there's, a company needs to be in a particular round of funding or a life cycle stage in their company, because I mean, as we have seen, a focus on ESG factors can be a competitive edge, and it's one where consumers and investors are really attracted to this as an area of focus. So I would just suggest that I think that this is a really compelling place to start and lens from which to think about funding needs for companies in all parts of their maturation stage. I think the key again is to you can't just say that it's an impact fund or that the issuance is focused on projects with ESG impact. You have to demonstrate it. It has to be outlined. You have to have risk factors and KPIs around it, and you have to be able to demonstrate and report to investors that you're doing what you say you're going to do. But otherwise, I think it's a very attractive. We can't get our hands on enough of these green bonds and other things that are coming to market because the demand profile is so large.
Yeah, and the other question is about new opportunities brought about by this ESG trends. Do you see in the short term there would be more players needed in terms of growing this whole ESG sector for wider adoption, say data provider on ESG benchmarking or ESG specialized auditors? What are some of the new opportunities and players that will be needed in terms of growing that?
No, I think that's exactly right. There's a whole value chain of ESG innovation that needs to occur across all of the functions that we think about in terms of investment management. So we talked a lot about integrating it into the investment process with the managers that you would employ. But like you said, accountants and financial reporting specialists and rating specialists and other kind of risk and reporting that you might see generally about company management, audits, all of those things. And we are seeing that where, again, entrenched companies, or at least those that are forward looking, are adding this capability and these practices to their existing practices so that they're able to serve this important area of the market. So again, it's in nascent stages and early days, but we're seeing it across all different aspects. And again, why we feel strongly that we've got to partner with all of the service providers because they each play an important role in the entire process to get to our end destination, which is that we want to offer really high quality ESG solutions to end investors. and to have those investors have strong confidence that when they're putting that dollar into that ESG fund, it's doing what they think it's going to do, and is oriented to areas that are important to them, and that they're able to then see demonstrably the outcomes. And again, I think we're at different stages of progress in each of those things, but that's what we're all working towards.
Yeah, and actually, regarding the ESG space, specifically in the US, one of the news that came through in the past couple of months was that basically the US Department of Labor, they recently proposed a new rule that would require private pension administrators to prove that they are not sacrificing financial returns if they put money in ESG oriented investments. So given the goal and nature of private retirement plans, is it wise to consider those plans as vehicles for furthering social goals? And what would be your take on that, whether or not it would be the right move?
Yeah, so I think this goes back to that first question, which is, are you giving up return by orienting to ESG strategies? And at least in the private pension and other parts of the market, we're seeing people say, okay, well, prove it, right? Prove it, because we've got pensions to fund, or we've got liabilities to pay, or we have projects that we want to fund, and we have to make the return requirement. And in a very low rate environment, an environment that's been very volatile, we need to do everything we can to try to get those returns first and foremost. And so you've got to make sure you're not giving it up. I think there's been some really good proof statements over the recent period where if we benchmark ESG oriented funds, to just call them kind of traditional funds in different asset classes, ESG has stood up extremely well. I know in our own case at Pimco, we've managed what would we consider SRI funds, or socially responsible funds, which we would say is kind of ESG 1.0. We've long worked with clients to exclude certain industries that they did not wish to invest in. You mentioned some of them: tobacco, gaming, other things like that. And we've done that for over 25 years. And so when we look at that track record versus what we call our full discretion, where we can invest anywhere we want, actually the ESG or SRI benchmark portfolios did pretty similarly. There was periods, of course, where there was dispersion between the two, but over longer periods of time, it was smoothed out, and you actually did not lose return in those portfolios versus those that could do everything. And so that's, I think, a longer term and interesting proof statement, and one that we need to continue to hone to prove to people that not only hopefully they don't give up return, but hopefully as we continue to evolve, they're going to outperform, given that hopefully they're oriented to more competitive companies who are innovating in these spaces and doing the right thing.
Yep. Another question that came through the Q&A function is that how can PE firms, funds, adopt a comprehensive ESG policy when quite frankly, there is no standardized framework available for ESG practices for now, and different LPs, they would try to push for their own versions of frameworks?
Yeah, no, I think that's absolutely an issue. I mean, we've seen some trailblazers in the PE space who have launched impact funds and other things like that with great success. But I agree with you. To date, there really is not standardization, which makes it incredibly difficult for end investors to be able to evaluate, how some of these PE firms are doing, or to compare kind of apples to apples between firms. So again, I would look at some of the thought leaders out there and look at, you'll see kind of more robust reporting and disclosures that are gaining traction, and hopefully we'll continue to see momentum there. But I guess I would agree with the current challenge, which is that it's tough to assess.
Yeah, and The other question about Pimco's approach and Pimco's view is that with COVID-19, it has brought up some interesting issues under social and health related categories and topics. So what are some of the factors that Pimco has been looking at under the social factor of ESG?
Yeah, there's been some really interesting issuance that has come to market, or just even companies that are doing, I think really innovative things to combat some of the issues that we're facing. So, for example, there was one company who has a REIT, a real estate investment trust. Obviously, that's one of the hardest hit areas in terms of real estate. Instead of laying off their workforce, they reoriented their workforce to areas of essential services and emergency services, and basically kept them on the payroll, kept their healthcare benefits, and provided their services, redirected their services. And as they're coming back now, I mean, the employee engagement that they have and the trust that they have in their company is really quite dramatic. So that's an example of them really taking care of their employees and trying to help them weather through some of these things. We've seen other companies really step up their healthcare benefits, both with respect to COVID specific aspects, but also things like well-being and mental health, which would have been important areas of focus over this period. Again, we think that those companies are going to have more stable, committed, and sustainable workforces that will help them propel further. We also saw, some companies who had tended to work with smaller companies in terms of their supply chain, make sure that they funded those small businesses, recognizing that they needed to be paid or else they would literally go out of business. And so they deferred their own cash flows in order to pay their supply chain to keep them alive and allow them to weather this storm. So those are some of the examples or the stories that we have been monitoring and looked at on the social side that we just think are incredible innovations over this period, and will allow those firms to weather this storm and to come out even stronger in the future.
But do you think so far with the current state of play, are all elements across ESG getting the right focus? Because of course it seems that the E factor is taking a bit more focus than S and G at the moment. What's your take on that?
No, I think that's a very fair question. I would look at it from two vantage points. When we at Pimco looked at joining the UN PRI, and this was back in 2010. So we've been a signatory since 2011. You obviously have to have criteria in your investment process to allow you to say, no, we're adhering to the UNPRI investment criteria. We are a signatory, and we are subscribing to the fact that we're managing our portfolios and we're upholding these values in the same way. And the strange thing is, we looked at ESG, and even though we weren't calling it ESG, we said, okay, let's actually start governance. We do that all day long. That is fundamental in terms of, as a bond investor, how we're investing. If a company or a country does not have governance or proper governance around how they're managing their company, how they're making decisions, the diversity and in their leadership and in their decision making, that's going to be, to us, one of the single biggest risk factors that will determine whether a company will pay you back or not. Because if they don't have strong governance, they're not going to do well. And we don't really see a lot of governance funds, or frankly, it's not very glamorous, frankly, to look at in terms of from an investor demand, but from a investment manager, it's critical. So we would say G gets probably the most across everything that we do. And then more recently, we have looked at the E and the S as really important non-financial risk factors to take in consideration. Now, I would say on the end investor demand side, E absolutely takes the top of the stage, both from an issuer perspective and then from the end investor perspective. So, you know, that 20 billion that I mentioned in issuance across green bonds and social, it's 90+% green bonds and about 10% social. So, I mean, hopefully that composition will change and we'll see a growing of the opportunity set. But certainly the environment and in particular climate has been at the top of everyone's list. Now social is gaining, but as we talked about before, from an investor perspective, it tends to be more difficult to orient an investment to a specific area of focus. We talked about, you know, social inequality or, you know, inclusion, diversity topics. Especially in bonds, it's hard to isolate those specific factors because they're such an important part of a whole company. But we're going to see more and more of those things. And we've begun to see issuance around some of these social aspects, particularly the COVID themes that we were just speaking about. So I think that it's going to gain importance, and it depends on which vantage point you come from, whether it's the issuer, whether it's the end investor, or whether it's the investment manager in terms of where you place most emphasis on.
Yeah, and other audience members is basically asking about this whole new framework around ESG, because of course currently this viewer is pointing out that traditional investing parameters along with ESG framework is essentially the new framework. But are there any elements in your view that are still missing from this new framework? Are there any other key important parts that needed to be considered and added to the new framework?
Yeah, no, I think we're on the right track is the short answer, but I do think that we can get a lot more robust with respect to things like financial reporting, consistent KPIs, and just overall transparency in companies about these, how they're thinking about these ESG risk factors, and how they communicate that both to investment managers who are purchasing their bonds, but then end investors as well. So yes, I definitely think there's more to do. There's more standardization. There's more detail that I think we can get there. There's more customization in the sense that different industries will have different ESG factors that will be more pertinent or relevant. And so we'll want to see, you know, how those conform according to different types of industries that we may invest in.
Yeah, and so far in 2020, during the global pandemic, would you actually say with the great interest around ESG, we could call it a new safe haven, given that it's an instrument that is expected to gain value specifically during periods of economic downturn? Or let's say if it's not just a safe haven, have you seen anything where ESG is really generating alpha?
Yeah, no, I think safe haven would be, you know, we have to be careful there because we still invest in companies and countries. And even if they're doing everything right on the ESG side, they can still go through a tough time. I mean, we're seeing that across almost all industries right now, just given the economic downturn. So I wouldn't say that it's a place where that it's going to be completely insulated from market events, whether they be a global pandemic or macroeconomic or geopolitical or all these things. I think that those issuers are going to be impacted. What I would say is that over the long term, we hope investors have long-term investment horizons instead of kind of going in and out of markets. And in those cases, we believe that those companies will have some more sustainable return profile that will give you a better end performance result over longer periods of time. And so in that regard, ESG will be really helpful in helping to navigate risks that we see in companies that will come up, as well as invest in companies who are doing innovative things and really addressing some of these ESG themes that we've been speaking about.
Okay, since we are almost out of time, but I would like to end this conversation with one more quick question, which would be some quick takeaways for the investment management sector after everything that we've seen happening in 2020. What are some of the lessons that you learned, Kimberly?
The lessons learned is that we cannot ignore ESG. It's here to stay, and it's now going to go faster than it did. And there's a lot of people working on it, but we're all going to evolve together on this in terms of establishing better frameworks, more transparency, more clear KPIs, so that we can measure the impact of our investments. And I think we're on our way, but we've got more to do. And I think it'll be an exciting period for ESG over the next 1 to 3 years, because I think we're going to see a lot of acceleration across the space, which will just be, it'll be better for the end investor, it'll be better for the global economy, and it'll be better for the planet.
Thank you so much, Kimberly, for the really exciting and informative conversation today. That was Kimberly Stafford, Head of Asia Pacific and Managing Director for Pimco. We do see there are lots of questions that came through the Q&A section. So we're not able to go through every single question, apologies. But if you do have any questions that you would still like to ask Lynk and Kimberly, please feel free to send through your questions at insights@linkknowledge.com. We'll try to send some of the questions to Kimberly and see if she could answer when she has time. But before we go, let's quickly revisit the poll that we've just run earlier about whether or not our audiences are thinking that ESG will take center stage. And so far, our audience members have spoken. 48% think yes, it will become a dominant trend, and 35% saying they will wait and see. So we will also wait and see and see if ESG is going to take center stage in the years to come. But this is it for this edition of Lynk Speaker Session. Thank you so much for joining us. Our Lynk users can use your Lynk Enterprise account to log in and go to the platform and go to the Lynk Insight section to catch up on all the recent webinars. But we got plenty more to come in September 23rd. We're speaking to one of Japan's best known APAC specialists, Melanie Brock, to dissect the Japanese market and any new opportunities that are coming from the current market forces and environment due to 2020 and COVID. But stay tuned for announcements about how to save your spot for the next session on our social media pages. We are on LinkedIn, Instagram, Facebook, and Twitter, actually. Thank you so much and see you very soon.